Welcome to the TaxSlayer Pro Basic Income Tax Preparation course. This is Module 14, Earned Income Tax Credit for filing 2018 tax returns. So what is a credit? Well, a tax credit reduces the taxpayer's current tax liability dollar for dollar. There are two categories of credits: refundable credits, where the credit amount is added to the federal income tax withheld. If the total is more than the tax liability, then the excess will be refunded to the taxpayer. And there's the non-refundable credit. This credit may reduce the tax liability to zero, but if the credit is more than the tax liability, then the excess is not refunded. Non-refundable credits include the Child and Dependent Care Credit, education credits, the Child Tax Credit, Retirement Savings Contributions Credit, and credit for the elderly and disabled. For example, if the total tax on the return were $481 and the child care credit came out to be $500, then the tax due or the refund would be zero. Now, just a word before we leave this slide. The child tax credit, I show it as a non-refundable credit. The additional child tax credit is the refundable credit, and we'll talk about that in just a moment. Refundable credits, and there it is, the additional child tax credit. Earned income credit is a refundable credit. The health coverage tax credit, the credit for prior year minimum tax, and excess Social Security and Tier 1 railroad retirement tax withheld are refundable credits. In this presentation, as I said, we're going to focus on the earned income credit. In this example, total tax on the return, $481, earned income credit, $500. In this case, the taxpayer would get a refund of $19. Earned income credit is a refundable credit. So what is it? What is the Earned Income Tax Credit, or some simply call it EIC? Why is it in the Payments section of the 1040? The Earned Income Credit, or EITC, is a tax credit for certain people who work and have low wages. The EITC may also result in a tax refund, as we just saw. The IRS website definition and a little background on the EIC. The Earned Income Tax Credit is a refundable federal income tax credit for low to moderate income working individuals and families. Congress originally approved the tax credit legislation in 1975 to provide an incentive for people to work. When the EIC or EITC is greater than the amount of taxes owed, it results in a tax refund to those who claim and qualify for the credit. Looking back at tax year 2017, approximately 30 million taxpayers received more than $69 billion in EIC. The average received per taxpayer was more than $2,500. Now, your go-to publication for the Earned Income Credit, for the rules, regulations, tables, and so forth, Publication 596, found on irs.gov. Who qualifies for the Earned Income Credit? Well, to qualify, the taxpayer must have earned income from employment, self-employment, or another source, and must meet certain other rules. In addition, the taxpayer must meet the additional rules for workers without a qualifying child, or have a child that meets all of the qualifying child rules. How much can you earn and still qualify? Well, this credit is typically targeted at households with modest income. So if you earn too much, you may not qualify. Well, just how much can you earn and still qualify for EIC? Depends on how many qualifying children you have, and we'll define qualifying children in just a moment. In tax year 2018, if you were married filing jointly had 3 qualifying children and earned less than $54,844, you would have qualified for this tax credit or even for a refund check. And how much is the credit? Well, the EIC varies based on income and family size. For tax year 2018, a family with 3 or more qualifying children could have received a refund of up to $6,431. Taxpayers may get money back even if they have no tax withheld. You qualify if you're single, or if you're married, you don't use the married filing separate filing status. You qualify if you, your spouse, and children, if applicable, all have Social Security numbers. You qualify if you have income from earnings, for example, from a job, your own business, union strike benefits, certain long-term disability benefits. You qualify if you didn't receive more than $3,500 in interest or dividends or income from rentals, royalties, or stock and other asset sales during the year. This is considered investment income. You qualify if filing married filing joint, the requirements for earned income are met if at least one spouse worked and had earned income. You qualify if you and your spouse are not being considered as a child or children on someone else's tax return for purposes of the earned income credit. And you qualify if you're a citizen or resident of the United States. You qualify if you don't happen to have a qualifying child, but you're between the ages of 25 and 65. In other words, under age 65 at the end of the year, not the dependent of another person, and you've lived in the United States for more than half the year. If you're married and file a joint tax return, either taxpayer can meet this age test. The amount of the credit can be determined from the Earned Income Credit table found in the instructions for Form 1040, or as we said, in Publication 596. You use the table to look up the taxpayer's income, family size, and then find out the amount of credit to which the taxpayer is entitled. Now let's look at adjusted gross income versus the earned income credit. EIC is based on a comparison of AGI, or adjusted gross income, versus earned income. The AGI is found on line 7 of the new Form 1040. You complete the EIC worksheets or have your tax software complete the EIC worksheets to determine the correct amount of earned income credit. For example, Julia is a single parent with 2 children ages 3 and 5. Julia has adjusted gross income of $18,770. This adjusted gross income includes earned income of $18,063 and interest income of $707. She meets the requirements for filing head of household and has no additional support. The EIC, based on Julia's earned income of $18,063, would be $5716 for tax year 2018. The EIC based on Julia's AGI, or adjusted gross income, of $18,770 would be $5692 for the tax year. Julia's amount of EIC is $5692, the lower of the two amounts. The maximum credit without children for this year, for 2018, $519 with one child, $3461, with 2 children, $5716, and with 3 children, $6431. And those whose incomes, filing status, and family size match the table in the right spots qualify for the biggest credits. The rules have been eased to result in higher credits for many households, especially those with 3 or more qualifying children. And those with incomes above the phase-out threshold qualify for lower credits until they reach the point where the credit is eliminated completely. If you were to plot the EIC tables, if you were to insert all of the numbers from the EIC tables into an Excel spreadsheet and plot the graph, we would see that the EIC comes out to be a bell-shaped curve. In other words, you would reach an income level where the EIC is maximized, and then it would begin to taper off as the income level increased. Put another way, a little bit of income results in a little bit of EIC. A lot of income also results in just a small amount of EIC. There's a spot where EIC is maximized according to the amount of income that the taxpayer receives. So just a quick review. Which of the following statements regarding refundable and non-refundable credits is correct? Refundable credits, such as the Earned Income Credit and all education credits, are funds actually refunded to the taxpayer. B. Non-refundable credits reduce the tax, and the refundable credits increase the federal tax withheld. C. Non-refundable credits include the Child and Dependent Care Credit. Or D. Refundable credits include the Health Coverage Tax Credit, while the non-refundable credits include the additional Child Tax Credit. Well, if you look at these very carefully, you'll see that C, non-refundable credits include the Child and Dependent Care Credit, is the correct choice. Does your child qualify? Does the taxpayer's child qualify for EIC? To qualify, the child must be a son, daughter, stepchild, adopted child, or a descendant, foster child, placed with the taxpayer by an authorized agency or court order, brother, sister, stepbrother, stepsister, or a descendant of one of these. The child must also be age 18 or younger as of the end of the year, unless he or she is a full-time student, in which case the student must be 23 or younger. Now there is an exception. A person who is permanently and totally disabled at any time during the year qualifies, no matter how old. To qualify, the child must also be younger than the taxpayer or the spouse if there's a joint return being filed. The child must have lived with the taxpayer in the United States for more than half of 2018. A child who was born or died in 2018 is considered to have lived with the taxpayer for all of the year. Temporary absences due to military service, school attendance, or detention in a juvenile facility is considered as time lived with the taxpayer. The child cannot file a joint return for the year. Now there's an exception to this as well. The joint return test does not apply if a joint return is filed by the dependent and spouse merely to claim a refund, and there would be no tax liability for either spouse on separate returns. Another example, Shelley, filing head of household, has a total tax on line 15 of the 1040 on her federal tax return of $140. She had $100 in federal withholdings on her W-2. Her earned income credit was calculated to be $1,800. Does Shelley get a refund, and if so, how much? Well, let's take a look. Her tax was $140, withholding from her W-2 $100. So she had a balance due of $40, but she received EIC of $1,800, so she gets a refund of $1,760. Again, EIC is a refundable credit. Now let's assume Shelley's filing status is married filing separate on her tax return. Will this make a difference on the amount of her refund? Absolutely. Remember, a married filing separate tax return does not qualify for EIC. Another example, Bob is a 24-year-old single taxpayer with no qualifying children. He earned $21,000 for the year. Now, according to the rules for EIC and the EIC table, how much earned income credit should Bob receive? None. To qualify for EIC, remember, a taxpayer with filing status single must be at least age 25, but under age 65 at the end of the calendar year. So in summary, the Earned Income Credit or EIC computation is based on filing status, number of qualifying children, earned income, and adjusted gross income. If the circumstances are right, taxpayers who have no children may also qualify. The EIC amount is determined using worksheets and the EIC tables. The EIC is entered in the payment section of the return and is a refundable credit. To claim EIC, the taxpayer must have a valid Social Security number that allows him or her to work. Married filing separately, again, this status is not eligible for EIC. Children also must have a valid Social Security number to qualify. The qualifying child must meet 4 tests: the relationship, age, joint return, and residency tests. Now let's take a look at a few review questions.